Hello and welcome. In this explainer, we're going to break down a really important tax-saving tool from the Hypothetical Income Tax Act of 2025, Section 86. We'll be looking at how this section can help you save tax on long-term capital gains when you invest in a residential house. So, let's get right into it.
So picture this. You've just sold a long-term asset. Maybe it was some land, shares, or even gold, and now you're looking at a pretty hefty capital gain. The first thing you're probably thinking is, okay, how can I legally reduce the tax I have to pay on this?
Well, the good news is, the law gives us a powerful tool right here in Section 86 of our reference text, the Income Tax Act 2025. This section gives you a clear path to claim a pretty significant exemption on those gains.
Now, if you've been in the tax world for a while, this might sound familiar. You see, Section 86 of the new 2025 Act is basically the new version of the old Section 54F from the 1961 Act. But while the main idea is the same, you've really got to get the details of this new law right.
So here's what we're going to cover. We'll kick things off with the main goal of Section 86. Then, we'll dive into who's eligible and the investment rules. After that, a case study will show you how it works in the real world. And we'll finish up with some key compliance points and our final thoughts.
All right, let's jump into our first section. So, what's the real goal behind this tax provision anyway? Why does it exist?
Okay, so the main goal of Section 86 is actually pretty simple. It's designed to give taxpayers a little nudge to push them to take their profits and invest them back into the housing sector. By offering a tax break for buying residential property, the government hopes to give the real estate market a boost.
All right, so we get why this law exists, but who can actually use it, and for what kind of assets? In this next section, we're going to decode the eligibility rules for Section 86.
The law is super specific on this one. The benefit of Section 86 is only for individuals and Hindu undivided families, or HUFs. Just a heads up, corporate entities like companies, LLPs, or partnership firms, they're not eligible for this particular exemption.
Now, there are three key conditions you have to meet. First, the profit has to come from a long-term capital asset. Second, the asset you sold cannot be a residential house itself. This exemption is for gains from other assets. And third, and this is a big one, on the day you sell your asset, you can't own more than one other house besides the new one you're planning to buy.
Okay, next up, the investment rules. And let me tell you, this is where you really need to pay attention. The details here are absolutely crucial. You have to nail the timing and the method, or you could lose the whole exemption.
This timeline lays it all out. You've got a couple of options. You can either buy a new residential house within 1 year before you sell your asset, or within 2 years after you sell it. Now, if you're building a house instead of buying one, the law gives you a bit more time, 3 years from the date you sold your original asset. And you have to stick to these dates. They're not flexible. If you miss them, you lose the exemption. It's that simple.
All right, enough with the theory, right? Let's run through a quick case study to see exactly how the math works out in a real-world situation. So, let's imagine someone sells a plot of land and gets 1.5 crore rupees from the sale. After we adjust the original cost for inflation, we find out the long-term capital gain is 50 lakh rupees. So the big question is, how much of that 50 lakh rupees is actually taxable? Let's look at two different scenarios here. In case one, the person invests 1.8 crores in a new house. Since that's more than the 1.5 crores they got from the sale, the entire capital gain of 50 lakhs is exempt. Your taxable gain is zero. Nice and clean. But now look at case two. Here the investment is only 1.2 crores. Because that's less than the sale proceeds, you only get a partial exemption. The formula is your capital gain, which is 50 lakhs, multiplied by the cost of the new house, 1.2 crores, and then you divide all of that by the net consideration of 1.5 crores. This gives you an exempt gain of 40 lakhs, which means you'll still have to pay tax on the remaining 10 lakhs.
Okay, let's talk about something that's super important for any tax professional or taxpayer, compliance and the common mistakes people make. Getting this part right is non-negotiable if you want to secure that exemption.
So, what happens if you need to file your tax return, but you haven't invested the money yet? Don't worry, the law has a solution for this. It's called the Capital Gains Account Scheme, or CGAS. You have to deposit the amount you plan to invest into a special CGAS bank account before you file your return. Then you can use that money later to buy or build the house, but remember, you still have to meet those original 2 or 3 year deadlines.
Now here's a number I want you to burn into your memory. 3.
The law puts a mandatory 3-year lock-in period on that new house you just bought or built. This means you cannot sell it or transfer it for 3 years from the date you bought it or finished construction.
So that begs the question, doesn't it? What happens if you break that rule? What are the consequences if you do sell that new house within the 3-year lock-in period?
Well, let's just say the consequences are pretty big. The law has what's called a clawback provision. Basically, that capital gain that you got exempted earlier, it becomes taxable as a long-term capital gain in the year you sold the new house. That tax benefit you got gets taken right back.
Now, this brings up a really important point about the transition from the old law to the new one. What if you claimed your exemption under the old Section 54F, but you sell the new house and violate the lock-in period after the new 2025 Act kicks in? Well, Section 536(2)H of the new Act covers this exact situation. The exempt amount becomes taxable in the year you sell the house, and it gets taxed under the rules of the new 2025 Act. This makes sure there's no loophole between the two laws.
Phew! We've gone through a lot of detail. So let's wrap this up by summarizing the absolute key takeaways you need to remember for Section 86.
To sum it all up, first, remember this is only for individuals and HUFs, and it's for gains on any long-term asset that isn't a residential house. Second, those investment timelines are incredibly strict. Don't miss them. Third, your exemption could be for the full amount or just a part of it, all depending on how much you invest. Fourth, that new house comes with a 3-year lock-in period. No exceptions. And finally, if you're running out of time before filing your return, make sure you use the capital gains account scheme.
And that is our deep dive into Section 86. We really hope this explainer has made it clear how you can plan your taxes when you have a long-term capital gain. Thanks so much for watching. Please don't forget to like, subscribe, and share this with anyone you think could use it.
Just a quick and important reminder, this content is for educational purposes only. It is not professional tax advice. Tax laws can change, and your situation is unique, so please always consult with a qualified professional before making any decisions.